Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications.
All right, folks, welcome back to another episode of Market Rising, the podcast where we dive deep into the weekly movements across Asian and European markets. I'm your host, Tom, and I've been trading these markets for over a decade. This week has been absolutely fascinating. We've got Porsche getting the boot from Germany's DAX index, Chinese tech stocks navigating the AI revolution, and Sony posting record-breaking operating income. So grab your coffee, settle in, because we've got quite the journey ahead of us today. Joy Up Invest Podcast. Invest better every day. Hello, everyone. Welcome to Market Rising, the show that brings you the latest updates on the Asian and European stock markets from the past week. Let's kick things off with our Asian market heat map. And what a mixed bag we're seeing this week. Think of the heat map as a visual temperature check. Green means hot money flowing in. Red means investors are cooling off. Starting with Singapore, which is absolutely glowing green this week. We're seeing strong performance from UOB, that's United Overseas Bank, one of Singapore's banking giants, along with Singtel, the telecom heavyweight. This tells us that Singapore's financial sector and infrastructure plays are finding favor with investors, which often signals confidence in the broader economy. Taiwan's showing some interesting dynamics too. While TSMC, the world's largest contract chip manufacturer, is trading sideways, meaning it's moving horizontally without much direction, other stocks in the market are picking up the slack. This diversification is actually healthy. It shows Taiwan's market isn't overly dependent on just one mega-cap stock. Now, Vietnam's painting a different picture entirely. We're seeing significant red across the board, indicating selling pressure. This could be due to global economic concerns filtering down to emerging markets, or perhaps some domestic factors. For investors, this might represent either a concern or an opportunity, depending on your risk appetite and time horizon. But here's where it gets interesting. India is absolutely stealing the show this week. The banking sector is on fire, with HDFC Bank and ICICI Bank posting solid gains. But the real standout is Bajaj Finance, which rocketed up 7.66%. Now, Bajaj Finance is a non-banking financial company, or NBFC, which basically means they provide financial services without being a traditional bank. This surge suggests strong confidence in India's consumer finance sector. South Korea is holding its own despite Samsung posting minor declines. The diversification we're seeing here across multiple sectors shows the market's resilience beyond just the tech giants. Hong Kong's where the real drama is unfolding this week. We're seeing a tale of two markets. Bright green from tech giants like Tencent, up 1.68%, and Xiaomi gaining 1.42%, while financial stocks like AIA are taking a hit, down 1.51%. Mainland China presents an even more complex picture, with a patchwork of red and green across tech and financial sectors. This brings us to the week's big theme, the AI transformation of Chinese tech stocks. Let's start with Baidu, which is essentially China's Google. Susquehanna just raised their price target from $85 to $95. And here's why this matters. Baidu is a perfect case study of the AI transition challenge. Their traditional online advertising business is struggling. Revenues dropped 15% year over year. But here's the kicker. Their AI cloud business grew a whopping 27%. Think of it like a traditional bookstore having to transform into an e-commerce and digital content platform. The old revenue streams are declining, but new ones are emerging. Baidu's overall revenue fell 4% to 22.7 billion yuan, but the AI-generated content on their search pages is expanding significantly. This is transformation in real time. NetEase, the gaming giant, presents another interesting case. They hit their EPS target of $3.23, which means earnings per share, basically how much profit the company made per outstanding share. But they missed revenue expectations by about $480 million, causing the stock to plummet 7.06% in after-hours trading. Now here's what's fascinating. Their gaming revenue grew 15%, and non-GAAP net income jumped 22%. GAAP stands for Generally Accepted Accounting Principles, so non-GAAP typically excludes one-time charges. Despite these strong operational metrics, the market punished them for the revenue miss. This shows just how high expectations are in the gaming sector right now. But amid all these challenges, Alibaba emerges as the week's bright spot. Benchmark raised their price target from $176 to $195, driven primarily by the strength of their cloud business, which grew 26% year over year. Now, Alibaba's quarterly results came in below expectations, but here's the context. This was largely due to asset sales and increased investment in quick commerce, which is basically ultra-fast delivery services. Think of it like Amazon investing heavily in same-day delivery infrastructure. While these quick commerce investments are pressuring margins in the short term, we're talking about 10 billion yuan in Q1 and an expected 50 billion yuan for fiscal 2026, the strategic potential is enormous. Benchmark estimates this could expand Alibaba's total addressable market to approximately 1 trillion yuan in the long run. Multiple analysts are upgrading Alibaba. Mizuho to $159, Morgan Stanley to $165, BOA Securities to $152, Bernstein to $160, and Goldman Sachs to $163. This consensus around cloud and AI capabilities suggests the market is recognizing Alibaba's transformation from pure e-commerce to a diversified tech infrastructure company. Shifting gears to Europe, we've got some major developments that really illustrate the changing economic landscape. The big news is Porsche getting ejected from Germany's DAX index on September 22nd, following a continuous decline in share price due to US tariff impacts on the European automotive sector. This is like getting kicked out of the exclusive club. The DAX is Germany's premier stock index, equivalent to the Dow Jones in the US. Scout24, an online platform company, will be taking Porsche's place. This swap symbolizes a broader shift from traditional manufacturing toward digital platforms. Meanwhile, LVMH is having a moment. HSBC upgraded them from hold to buy, raising their price target from 535 to 625 euros. The catalyst? Expectations around Dior's revival under Jonathan Anderson's creative direction. His recent men's collection generated over 1 billion impressions, which in marketing terms is massive reach.
Now, LVMH just dealt with a data breach affecting 419,000 customers, but analysts are looking past this temporary setback. HSBC specifically noted meaningful upside potential versus risk with Anderson at the helm. This suggests confidence that creative leadership can drive brand value despite operational hiccups. In pharmaceuticals, Sanofi is getting attention from Jefferies, who maintained their buy rating with a €120 price target, specifically citing the safety profile of their drug amlitelimab. The fever and chills rates are remarkably low at just 1.1% and 0.4% respectively, compared to competitor Amgen's rates of 9% and 5%. This might sound like technical details, but in drug development, side effect profiles can make or break commercial success. Sanofi's Phase 3 COAST-1 study showed 21.1% and 22.5% of patients achieved clear or almost clear skin, compared to just 9.2% on placebo. The drug targets OX40 ligand without depleting T cells, which is a more targeted approach that avoids some nasty side effects.
Finally, let's talk about ASML, the Dutch semiconductor equipment giant that UBS just upgraded with a price target increase from 660 to 750 euros, maintaining their buy rating despite the stock underperforming the market by about 20% over the past year. UBS believes the inflection point will come in 2027, driven by increased capacity at TSMC's A14 node and significant high-NA technology deployment. Now, high-NA stands for high numerical aperture. It's basically next-generation lithography technology that can create even smaller, more precise chip features. They're projecting shipments of 6 and 10 high-NA systems in 2027 and 2028 respectively, which could represent about 30% of revenue growth in those years. The company is forecasting 20% average annual EPS growth from 2026 to 2030, suggesting they're positioning for a strong comeback in the semiconductor cycle. Despite ongoing uncertainties around China restrictions and lithography technology intensity, analysts believe the worst of the cycle is behind us. This is particularly important because ASML is essentially the monopoly supplier of the most advanced chip-making equipment in the world. Looking back at news from Japan's tech and gaming world, we have some quite interesting developments. Starting with Sony, which delivered impressive Q1 2025 results with record-breaking operating income of 340 billion yen, up 36% year-over-year. This growth was primarily driven by their PlayStation gaming business, which saw monthly active users surge to 123 million. PlayStation 5 is also growing 32% faster than PS4 at the same point in their respective life cycles, showing that gamers continue to hunger for new gaming hardware. CFO Lin Tao mentioned the company is shifting from just selling hardware to building player communities, which sounds like they're learning from the success of modern online gaming ecosystems. However, there are some challenges ahead. US tariffs are expected to impact them by 70 billion yen this year, and the delayed launch of their marathon game could affect near-term revenue. Meanwhile, Nintendo faces some headaches as Freedom Broker issued a hold recommendation with a price target of 13,340 yen per share, citing risks around the Switch 2 potentially having a high price point and limited new software. This could make gaming fans cry over higher prices. While Nintendo still has momentum from their upcoming console launch, they need to be careful about pricing strategy. If it's too expensive, people might just stick to mobile gaming instead. So what's the big picture here? We're witnessing a massive structural transformation across global markets. Traditional businesses are facing pressure, while new technologies like AI and cloud computing are showing tremendous growth potential. For investors, the key takeaway is to focus on companies that can successfully navigate this transition and invest appropriately in future technologies. The analyst upgrades we're seeing across AI and cloud companies suggest this could be the beginning of a longer-term recovery. Remember, investing is about seeing the forest through the trees. Short-term volatility is just noise when markets are restructuring themselves for the next decade of growth. The companies that emerge stronger from this transformation will likely be the ones driving returns in the years ahead. As always, invest wisely, stay diversified, and remember that, as Benjamin Graham said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. That wraps up this week's Market Rising. Thanks for tuning in, and we'll see you next week for another deep dive into global market movements. Until then, keep riding those market waves. And remember, everything I've shared today is just my personal view, not investment advice. So please always do your own research, think it through, and keep in mind, investing always carries some risk. Before we call it a day, don't forget to like, share, and hit that notification bell on JoyUp Invest so you'll never miss our daily bite-sized insights from markets all around the world. Now I'm curious, what stocks are you holding right now? Go ahead,